Welcome back to the School of Everything, where we make complex topics easy to understand. Today we're diving into the shadowy world of money laundering. Ever wondered how criminals hide their ill-gotten gains? Let's break it down. Money laundering is a critical issue in the financial world. It's the process of making large amounts of money generated by a criminal activity, such as drug trafficking or terrorist funding, appear to come from a legitimate source. Understanding this process is essential for everyone, not just those in finance. Let's start with the basics. Money laundering typically involves three stages: placement, layering, and integration. Each stage plays a crucial role in disguising the illicit origins of the money. The first stage is called placement. This is where the dirty money, often from illegal activities like drug trafficking or corruption, enters the financial system. Criminals need to find a way to convert their cash into something that looks legitimate. This could be anything from buying expensive items and then reselling them, to depositing smaller amounts of cash over time into different bank accounts. Next, we have layering. This stage involves shuffling the money around to obscure its origins. Think wire transfers between accounts, buying and selling assets like cars and properties, or investing in shell companies. The goal is to make the money trail as complex and confusing as possible, and to make it impossible to trace the money back to its original source.
Almost impossible to trace.
Almost impossible to trace.
Layering can be quite sophisticated, involving multiple transactions across different jurisdictions. Finally, integration. This is when the cleaned money re-enters the economy, appearing legitimate. It could be through investing in legitimate businesses, purchasing luxury goods, or simply withdrawing from a bank account. By now, the money looks clean, and the original source of the funds is virtually untraceable. The rapid growth of online banking, anonymous payment services, and peer-to-peer mobile transfers has created a complex environment where tracking the illegal movement of money is increasingly difficult. This digital transformation has made traditional methods of money laundering more sophisticated and harder to detect. One of the most significant challenges is the anonymity offered by the internet. Proxy servers and specialized software allow criminals to obscure their digital footprints, making it nearly impossible to trace the origin of funds. Online platforms such as auction sites, gambling websites, and virtual gaming platforms have become popular tools for money laundering. Criminals can convert dirty money into virtual currency, which can then be easily converted back into clean, untraceable cash. Cryptocurrencies like Bitcoin have further complicated the issue. While not completely anonymous, they offer a level of privacy that traditional currencies lack. This characteristic has made them a preferred method of payment for various criminal activities, including blackmail, drug trafficking, and other illicit ventures. The evolution of digital finance has undoubtedly created new opportunities for legitimate businesses and individuals. However, it has also provided a fertile ground for those engaged in criminal activities. Combating electronic money laundering requires a multifaceted approach involving law enforcement, financial institutions, and technology providers working together to stay ahead of cybercriminals. Now let's delve deeper into some common money laundering techniques. These methods are often used in combination to maximize the chance of success. First up, we have smurfing. This involves breaking down large sums of money into smaller, less suspicious amounts. These smaller amounts are then deposited into various bank accounts. The name smurfing comes from the idea of numerous small transactions, much like the many small smurfs. By keeping deposits below regulatory reporting thresholds, criminals avoid detection. This method relies on the fact that smaller transactions are less likely to attract attention from authorities. Next, we have shell companies. These are businesses that exist only on paper with no real operations. They're often set up in tax havens or jurisdictions with lax regulations. Criminals use these shell companies to move money around, creating a complex web of transactions that's hard to trace. For example, a criminal might set up a shell company in a country with strict banking secrecy laws. They then transfer funds between multiple shell companies to obscure the money's origin. By the time the funds are withdrawn, it's challenging for authorities to trace the money back to its illicit source. These companies can be set up in jurisdictions with lax regulations, making them perfect for hiding money. Trade-based laundering is another sophisticated technique. It involves manipulating invoices to disguise the movement of money. This could mean under or over-invoicing goods and services, or even creating fake invoices. Picture a company that exports goods. They might invoice a foreign buyer for a higher amount than the actual value of the goods. The buyer pays the inflated invoice, and the excess money is laundered in the process. This method leverages the complexities of international trade to hide illicit funds. For example, a company might ship goods worth $10,000, but invoice them at $100,000, thus moving $90,000 undetected. Real estate is another popular method for laundering money. Criminals purchase properties with illegal funds and then sell them to integrate the money into the legitimate economy. The high value of real estate transactions makes it easier to launder large sums of money. Here's how it works. A criminal buys a property with dirty money, perhaps through a shell company. After holding the property for a while, they sell it. The proceeds from the sale appear legitimate, as they come from a seemingly normal real estate transaction. The high value and low liquidity of real estate make it an attractive option for laundering money. Casinos and gambling establishments can also be used for money laundering. Criminals convert their cash into chips, gamble for a while, and then cash out, often receiving a check from the casino. The money now appears to be gambling winnings, which can be difficult to trace back to its illegal origins. Imagine a criminal walks into a casino with a large amount of cash. They buy chips, play some games, and then cash out the remaining chips. The casino issues a check for the chips, and the funds now look like legitimate gambling winnings. Financial institutions play a crucial role in detecting and preventing money laundering. Let's explore some mechanisms they employ. Know Your Customer (KYC) policies require banks to verify the identity of their clients. This helps ensure they know who is using their services and can flag any suspicious activity. This involves customer due diligence, CDD, and enhanced due diligence, EDD. Customer due diligence is the process of identifying and verifying the customer's identity and understanding the nature of their activities to assess the risk they pose. This might involve checking identification documents, verifying addresses, and understanding the customer's financial behavior. Enhanced due diligence is a more rigorous process applied to higher-risk customers. This includes gathering additional information and more thorough verification to ensure the legitimacy of the customer's activities. EDD might be applied to politically exposed persons, PEPs, or customers involved in high-risk industries. Criminals are constantly finding new ways to disguise illegal funds as legitimate income. To combat this, financial institutions employ various strategies, and one of the most effective tools in their arsenal is transaction monitoring. But what exactly is transaction monitoring? In essence, it's a process where financial transactions are scrutinized for suspicious activity. This involves monitoring customer transactions in real time or near real time, analyzing patterns and identifying anomalies that could indicate money laundering. Let's break down the steps involved in transaction monitoring. Financial institutions collect vast amounts of data from various sources, including customer transactions, account details, and behavioral patterns. Advanced algorithms and software analyze this data to detect unusual patterns. For example, sudden large transfers, rapid movement of funds between accounts, or transactions that don't match a customer's profile. When the system detects potentially suspicious activity, it generates alerts. These alerts are then reviewed by compliance officers to determine if further investigation is needed. If an alert warrants further scrutiny, a detailed investigation is conducted. This might involve gathering more information about the transactions, the parties involved, and the source of the funds. If the investigation confirms suspicions of money laundering, the case is reported to the relevant authorities, such as the Financial Intelligence Unit, FIU, in the respective country. Transaction monitoring systems rely heavily on sophisticated software and technologies, such as machine learning and artificial intelligence, to efficiently sift through large volumes of data and identify red flags. But human expertise is just as important. Compliance officers play a crucial role in interpreting alerts, conducting investigations, and making informed decisions. Now, you might be wondering, why is this so important? Well, effective transaction monitoring helps prevent financial crime, protects the integrity of financial systems, and ensures compliance with legal and regulatory requirements. It's a key component of a robust AML program and crucial in the fight against money laundering and terrorist financing. To sum up, transaction monitoring for AML is a complex but essential process that combines advanced technology and human expertise to detect and prevent illicit financial activities. Sophisticated software can detect patterns that indicate potential money laundering. When banks detect potential money laundering, they file suspicious activity reports, SARs, with regulatory authorities. This helps law enforcement investigate and act on possible criminal activity. These reports are crucial in tracking down and prosecuting money launderers. AML software uses algorithms to detect and flag suspicious activities. This technology helps banks stay ahead of increasingly sophisticated money laundering schemes. Interestingly, money laundering wasn't officially recognized as a crime in the USA until 1986 with the passage of the Money Laundering Control Act. This legislation made it illegal to engage in financial transactions with proceeds generated from certain criminal activities. This was a significant step in the fight against money laundering, setting the stage for the development of more comprehensive anti-money laundering (AML) laws worldwide. Money laundering is a complex and evolving challenge, but understanding its mechanisms and the efforts to combat it is crucial. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and hit the bell icon for more insightful content. Until next time, stay informed.